the Japanese at the moment have got their foot on the accelerator if we're in a Japanese car. Whereas in the US and UK, central banks have got their foot on the brake because they're just trying to slow things down.
However, I recognise when I'm on a sticky wicket and that we are only talking about 2.5%. If it puts a smile on Rich's face for Christmas, then it's worth us doing.
Which leaves us officially fully invested. Is that right?
But that seemed to me to be a one-off impact, which we'd never seen before.
I could tell what's coming.
I am grabbing the yellow card. I very nearly went for red. This is one of those examples of people making things up as they go along. So, what always used to happen is people would say, oh, the inflation numbers are up 5%. But if you take out everything that went up, they're only up 2. And isn't that a good number? No, it's 5%.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results.
Welcome to episode 22 of The Art of Investing, IG's award-winning podcast. That's right, you heard it correctly, award-winning. We managed to walk away with 3 awards, gentlemen. I calculate that as 1 each, so I'm going to dish them out. Best Financial Podcast from the Good Money Guide. I'll take that one.
Hey.
Then we've got Best Financial Analysis. Chairman, we'll give that to you.
Wow. I've never analysed it in my life. That's pretty good.
And then finally, best haircut in a podcast going to Mark Spice Holden.
I'll take that.
But we'll also give you best investing education as well.
Oh, thank you.
Chris Fellingham, what would you like to see?
I wanted to thank all our listeners, but especially those who voted for us in these awards. Like all politicians, I like to say we're humbled by the support you've shown us. But once again, everybody voted for us. Thank you so much. We're glad you're finding it useful. Please continue to recommend us to your friends, but we will bask in our glory for a few weeks.
We were very touched by it, weren't we, Spice?
We were. I'm over the moon, Saint, as they used to say.
And then the second title that we were awarded this week was the Top Gear of Financial Podcasts. I like that.
Now, I'd like to hear you now say who's who for that.
Well, I think one of them's obvious, isn't
James May is spicy. Captain Slow.
Well, thank you for that. But eventually get there.
it? Clarkson?
Well, there's only one gobby one on this team, isn't there?
Brilliant. That's
Farmer Fellingham.
So that leaves, we can include the new series. So I would take a Flintoff, be happy with that. I'd be happy with the guy from Friends, Matt LeBlanc. How you doing?
Oh dear.
So we go on to the Spice Market.
let's move on quickly.
Maybe we should carry on. Otherwise, we've lost everybody who's voted for us. Keep going.
Go on, Spice. What is happening this week?
Well, it's been another very volatile week, particularly in cryptocurrency land. Bitcoin, pretty much as soon as we finished the podcast last week, fell 10% again, down to a sort of new 6-month low. It's bounced all the way back up. So maybe we're through it. I don't know. We've said that a few weeks ago. I don't know. But it remains very volatile and obviously one area for people with very good nerves to sort of play in there. I think it was sparked a little bit by China saying they were going to clamp down on sort of illegal crypto and sort of exchanges across China. And that seemed to be the bell that sort of started the sell-off. But since then, obviously, we've seen a bit of recovery, which is good. One of the main features of the week has been the fact that the dollar, the US dollar, has actually been quite weak. And that's played into our portfolio. Like the weak dollar's in a basket of other currencies against the euro, the yen and sterling has fallen about 1.5% this week, which is quite a big move in currency land. And that's helped commodities a lot. So for the first time in a few weeks, I've been able to say there's been a new all-time high.
Wow.
Well, yeah, we haven't been able to say that for a while. This time in silver. And which has been racing away.
The one that we don't have.
Yes, well, we have some in.
We have some in the
Black Rock
mining,
mining.
I presume.
Yeah, we do. Yeah, gold is very close again to its all-time high, so close behind it. And copper has made a new post-crash high. I remember back in July they had that biggest ever one-day fall where they fell 30%, or copper fell 30% as Trump changed the tariff regime for copper. So it's retraced about half of that loss now. So it's actually been doing quite well, nice and steady recovery. And it's, like I say, it's at a post-crash high, which is really good. In oil is still struggling a bit in the background. As you know, we don't own oil in the portfolio. This week, it had a little bit of a bump because Trump has been escalating the tensions with Venezuela. And just for those of you who don't really follow this closely, Venezuela has the biggest oil reserves in the world, much bigger than Saudi Arabia. They've got something like 300 million barrels of oil that have been sort of reserves that have been identified, and Saudi only have about 260, 270. But they only produce 1 million barrels of oil a day, and that's because they've been underinvested, they've had lots of problems with civil wars and underinvestment, so they can only produce about 1 million barrels a day. Whereas back in the sort of the 90s, they used to produce 3 to 4 million barrels a day. So that's one of the reasons that the oil supply remains quite tight in the world. The S&P managed to end November with a small gain. I think it was up about 0.5%. So by the skin of its teeth, it made a positive return on the month. So it made it the 7th month in a row of gains in the S&P. I have to say some of the other markets didn't do that. NASDAQ didn't make a gain in the day. As we know, November is a very good month seasonally, and principally because of, you get into Thanksgiving. But now we're going into what is also normally seasonally quite a good month in December, and we brace ourselves for the Santa Rally. But the Santa Rally, the sleigh seems to have had the brakes put a little bit on it this week because events in Japan. The governor of the Bank of Japan basically turned around and said that he was considering a rate rise at the meeting, which is in about 2 weeks' time.
The story's back.
Exactly. So, I mean, we talk about this as a rate rise. I mean, to put it in perspective, they have 0.5% interest rates or 50 basis points of interest rates at the moment. And the speculation is now that there's probably a 70% chance that they're going to add another 0.25% to that. So another 25 basis points. So interest rates, Japan just going from 0.5% to 0.75% potentially in 2 weeks' time. But that was enough to make Japanese government bond yields. Remember, when yields go up, the prices go down. So Japanese bond yield prices fell as the yield rose to 1.9%, which I think is the highest in a very, very long time. Chrissy, I know you're going to talk something about.
I think it's quite interesting what's going on in Japan. And I'm going to get a little bit complicated here. Probably too complicated for pre-Christmas podcasts, but let's try anyway, because the Japanese bond market is telling you where it thinks interest rates are going, and it would be good to help people to understand what that progression looks like.
I'll get my school jotter out. I'm ready.
Right. So let's go back to first principles. If I have a 30-year bond, and I also maybe have a 10-year bond, I can work out from that mathematically what the 20-year rate will be in 10 years' time. So think about that. I've got a 30-year bond. The first 10 years should match the 10-year bond itself. So I can then take away, essentially, mathematically, not in terms of just simple subtraction, the 30-year information and the 10-year information to give me, in 10 years' time, what a 20-year bond would yield.
And can I just drill down into that and a very simplistic, when you say a 30-year bond, what does that mean?
Okay, so if we're in 2025, I'm saying a bond with a maturity in 2055.
So that's when I get my money back.
So that's when you're going to get your money back, and you're going to get a yield over that whole period. The 10-year bond is a 2025-year bond maturing in 2035. So then if I transport myself by my wonderful time machine, which I wish I had, into 2035, I can then say what level of yields would be equivalent for a 20-year bond then to give me the same return as if I'd got my 30-year bond originally and then that 10-year.
Right.
I am going to say that just once more, just to be clear. If I have a 30-year bond and a 10-year bond, I can work out what the 20-year rate should be in 10 years' time. And what that rate is the rate that would give me the same result from if I held the 30-year bond or I held a 10-year bond and then in 2035 reinvested into a 20-year bond.
If you were going to tell that in story terms, what does that help you decipher?
Okay. So what that then tells me is if I go forward in my wonderful time machine again to 2035, it's telling me what a 20-year bond would yield. So if I know what a 20-year bond would yield then, I can compare to what a 20-year bond yield looks now to get an idea of what interest rates are being discounted in the marketplace. Okay? So this is where bonds are very good because they're mathematical. If you know various maturities, you can work out what that's implying for where interest rates will be. Okay? So let me give you an example. Japanese cash, as Mark has said, yields 0.5%. So that's where their interest rates are, 0.5%. The 10-year bonds yield 1.9%. Their 30-year bonds yield 3.42%. Okay? Now, if I do that calculation I've just talked about, if I take that 30-year bond, 3.42%, I take the 10-year bond, 1.89%, I do my mathematics, then, sorry, I'll do that again. Sorry, I just like it now, that's good. If I do that, then the 20-year bond in 10 years' time would yield 4%. So the market is telling you that 4% is being discounted in the longer term interest rate structure. Even though none of the bonds yield 4%, it's because they're so low in the immediate bonds and so high on the longer term bonds, the balance to get the right amount overall is a much higher level. So what this is telling you is that Mark says rates are at 0.5%, will they move by a quarter or not? It's already discounted. They're going to go to 4%.
And that's what that tells you.
And that's what these calculators tell you. Now, what this also tells you when you look at it is actually a lot of those rate rises are expected 6 years' time, 7 years' time, 8 years' time, 10 years' time. So what's really happening is they're saying the Japanese monetary policy is going to gradually tighten over time, but nothing quickly. So the risk in Japan, and this is what we'll have to watch very carefully, is that because they're running their interest rates quite low, inflation is around about 2.5% to 3%. So they're well below inflation. If that boosts growth and the Bank of Japan suddenly say, we're worried about inflation picking up more, then suddenly they will price in a much quicker move up in these interest rates. And that will be the danger for the Japanese equity market. We're not there at the moment. We have a 10% position in Japanese equities. We're comfortable with that at the moment because we're still doing them very slowly. But we need to watch very carefully what the message starts to be from the Bank of Japan.
I think it's really important for equity investors because they look 3 to 6 months forward. When they're most optimistic and they think everything's going to be okay and there's no bumps along the road, they'll look further forward. So they'll look 6 months out. If they're a bit uncertain about what might happen, they might look maybe 1 month forward or 2 or 3. So the market is saying that, yes, they might put interest rates up by 0.25% at the next meeting in 2 weeks' time to 0.75%. But then it's unlike the markets are saying it's very unlikely that you get another rate rise for at least another 6 months.
So very slow
and steady. And that's good for equities because you don't have any of those bumps. You don't have to deal with it. Now, the first reaction of the equity market this week, as you'll see when we come to the portfolio, was to mark Japanese equities down a bit. And the Japanese yen went up. Now, for Japanese equities, the yen going up is a little bit painful. It's a bit like the pound going up for the FTSE 100. So the FTSE 100, remember, 85% of their earnings come from overseas. So when the pound goes up, their earnings go down. And when the pound goes down, their earnings go up. Well, the same sort of thing happens in Japan in the Nikkei 225, which is their big index. About 70% of the earnings of those companies come from overseas. So they have the same effect. In fact, Japan is the second biggest, most affected market by currency.
Wow.
Apart from the FTSE 100.
And what kind of companies are those then, Mark?
Well, there's people like Toyota who make the cars, SoftBank who have big technology businesses. They owned Arm Holdings, remember? One of our great British companies that ended up in Japanese hands. Yes, we won't go there. We won't go there. But, the Japanese equity market is also looking at other things because they've got a new prime minister, if you remember, in Japan. And basically, they've said that they are going to spend £100 billion worth of stimulus in the next year or so to try and get their economy going. So although they've got inflation at about 2.5%, 3%, growth is only at about 1%. Now, we would love growth of 1% in the UK, and we'd love inflation of 2.5% to 3% because we've got nearly 4% inflation in the UK and 0.5% or 0 to 0.5% growth in the UK, and interest rates of 4%. So, hopefully next week, we will find out that the Bank of England will also cut.
If I was going to summarize all this in one sort of simple analogy, it would be driving a car. And in Japan, especially because they make such good cars, the Japanese at the moment have got their foot on the accelerator if we're in a Japanese car. Whereas in the US and UK, central banks have got their foot on the brake because they're just trying to slow things down, aren't they? Because it is operating something called accommodative policy. An accommodative policy, easy for me to say, is when...
Rather you than me.
As you say, the interest rates are lower than inflation is. So that should be stimulative to growth. In this country and in the US, we're the opposite, aren't we? We're on restrictive policy, the opposite of that stimulation. They're trying to restrict borrowing just to keep things under control and to keep that inflation moving down towards target. So it will be really interesting to see if Japan can keep that inflation number under control and we stay to the path of slow increases in interest rates. Because I know if we were in the US, everybody would be arguing, get those interest rates up quicker, wouldn't they?
There's lots of different views and different thoughts, but people generally assume that government spending is pretty inflationary. So in Japan, they've got massive government spending, inflationary, growth picking up, inflationary, and interest rates well below inflation. So as long as that slow, steady move in interest rates rather than any panic, it's going to be good for the equity market. The danger is, as I say, if somebody turns around and says, we need to start getting restrictive because we don't like inflation here at this level, and we think it's going to pick up too much and we want to stop that happening, that's when we're going to have to watch out in Japan. And that's in the UK, and it's the issue we have here, which is we have, an economy that's slow, but we're not getting our inflation down. Therefore, the interest rate cuts, when they come, are slow and not very often. Mm-hmm. And so we never get to an accommodative policy, which helps the growth outlook.
I think it's really important to, and probably the last thing to say on Japan is that remember that for 20 years they had deflation. So prices were going down. And once we've talked about the psyche of deflation, why would you buy something today if it's going to be cheaper tomorrow? So you don't. You defer your decision to buy, and therefore that hurts demand from the economy, prices fall even further, and you get in this horrible downward spiral. And they had that for 20 years. And to get out of that psyche, they've had to get people to think that inflation is good. And that is why they are happy to keep interest rates very low and pump in 100 billion pounds worth of extra stimulus next year to keep this psyche of inflation going. Because they want people to go, do you know what? If the price is going up, I might buy it today. So they'll make that purchasing decision. That helps the underlying economy. A bit of that helps. If you have too much of it, clearly it's too bad because then interest rates have to react. But that's the history of Japan getting to the point where we are now, which is why they're nurturing and treading very carefully with these interest rate rises. Because if they go too fast, they'll get this deflationary mentality back, and that'll be very damaging for the economy and for the stock market. We would sell all of our position if we thought deflation was coming back in Japan. So away from Japan and Japanese government bonds, other global bonds have actually been pretty well behaved this week. They're pretty stable. And believe it or not, gilts have been pretty stable despite our views of the budget. The rest of the world have forgiven them so far.
It takes time for people to see the lights.
All that gloom and doom mongering last week.
Well, look, this time next week, we'll know what the Federal Reserve will have done with their interest rates. As I've mentioned previous weeks, the odds on them putting through a 0.25% interest rate cut on Wednesday next week, which is the 10th of December, have increased from 3 weeks ago at 30%, now up to about 90%. So that seems pretty nailed on. And the background economic data that we've had, and it's still sparse because of the government shutdown, has been supportive of an interest rate cut. In the UK, the day after, we will find out what the Bank of England do. But actually, because the budget hasn't been that bad in the perception of the world, and bonds have behaved themselves and sterling has behaved itself as a currency, then it gives scope for the Bank of England also to cut by 0.25%. And so the market's now saying there's a 90% probability of an interest rate cut by the Bank of England at the end of next week too. So fingers crossed for those of you with mortgages that will come through.
Right, so on to the portfolio then. Very important we get it watertight this week before those big interest rate decisions, which will happen before we get the chance to change anything in the portfolio again, Mr. Chairman. If we look through this week, it has been another fine week, hasn't it? Up 0.8% to take us total portfolio returns since inception of 9.8%. The big winners on the week, as Spice alluded to in the market update, Mr. Chairman, that World Mining Trust.
Doing very well. I'm very glad that I bought the extra 5%.
So that now a total return since inception of 25%. The BlackRock World Mining Trust, top of the leaderboard this week, up 5.4%. Then we've got copper up 3.3%, which is approaching a 20% return since inception. More to come on that in a second, I feel. That Crypto and Blockchain Innovators ETF, despite the drop in crypto on Monday morning, actually putting in quite a nice return there of 2.5%. And then towards the bottom of the leaderboard, unfortunately, India did cost us this week, down nearly 3% on the week. Total return since inception, 4.7% on India. The EM Emerging Markets ETF followed suit, down almost 1%. And then the Nikkei that we've gone into detail there, down 0.7% on the week, but still up 13% since inception.
Okay, so when we look at that, we do see quite a big drop in India this last week. We talked about that a number of times. We talked about our India performance, and it's actually worked pretty well as an offset. When markets have gone down, India's done quite well. And now markets are doing well. India's not done quite so well. It's quite a big fall, that, Mark. Anything special going on?
There's concerns that the US trade talks on tariffs with India, which if you remember are 50%, 50%, so they're very large. There was hope a few weeks ago that they were going to be reduced back down towards 25% or even lower. That sort of chances of that seem to have diminished a bit. And at the same time, that's then caused foreign investors to take money out of India. So the rupee, which is obviously their currency, has fallen as well against other currencies. And because it's quite a domestic market, it actually, ironically, it gets affected when the currency goes down. It hurts them a little bit, ironically, unlike other markets. And that's also had a knock-on effect to the emerging markets, because India is the second biggest part of the emerging markets behind China.
That's great. So if we just broaden things out a little bit, and we're up at 9.8%. We've got 2 interest rate decisions coming up. We can, and there's bound to be more than 2, but 2 that's going to affect us, the US and the UK. I'm not really minded to do anything in the portfolio in terms of our positioning around the equity markets and things like that. We're running into the Santa Rally. Hopefully the brakes are going to be taken off the sleigh that Mark was talking about, and it's going to run beautifully for us. But what I did want to revisit was the fact that last week we had a impassioned plea from our friendly Scotsman around copper and whether we should be thinking about copper. Having looked at its price action, as Mark said, it had a terrible sell-off, a big 30% sell-off earlier this year when the tariff rules were changed, and it is clawed its way back to get half that back, but it's still a long way away from its old highs. So maybe there's a little bit of potential.
Going back to the really simplistic supply and demand, one of the reasons I like copper, as Rich does, is that the supply and demand dynamic for copper is great because AI wants to use a lot of energy transmission. Copper is still the main component of energy transmission, although there are other people who use aluminium and other alloys. But copper is still the main component for most of these things. And so it is growing at a higher rate than global gross domestic product, global growth. And yet we know, because when we did the deep dive on copper right at the beginning of these podcasts, we noticed that there is no new supply coming on. In fact, there's been some supply constraints because if you remember, there have been problems with some of the biggest mines in the world that have had accidents, and so supply is being constrained. So the price naturally should go up, increased demand, limited supply, O-level or GCSE economics means that the price should go up. Exactly, O-levels.
I didn't know you got O-levels, boys.
Yeah, well, I got 1 or 2.
What does the O stand for?
Oh my goodness, I got one. I believe copper is probably one of the best placed metals out there. Also, at the same time, China is still struggling to get any growth going. So the chances of them doing another big boost to try and get their industrial production going, which would involve using more copper, is quite high as we go into the new year, I think. So I like copper. I think it will go back to those highs that we identified. Obviously, we were lucky that we weren't in the position when they had the big drawdown and Trump changed the rules. But we used it as an opportunity. We said at the time, this is a one-off opportunity. Had a 30% fall in one day, unheard of. We started buying it then, and I believe we've got further to go. So I would back actually having more on copper.
The thing that really stood out to me last week was BHP reapproaching Anglo-American. And this is there's been an 18-month break in any merger talks. But BHP is dying to get the copper assets of Anglo-American. And we know the mining companies are in it to play the long game, right? They think 10 years ahead because they know they can either spend that long building the production or they can just buy it today. And that really underlined the supply dynamics that Spice has pointed out there. And I think this could be one of the really big stories of 2026. So, yep, it would be playing the long game, but, that's what we're all about here. And I see that 2.5% sitting in cash and think that would be a very nice addition because not only do we have 5% of Wisdom Tree copper ETF, we've also got copper exposure in the World Mining Trust of around about 2.5%. If we decided to take the cash today and invest in copper, we'd have exposure of about 10% in the portfolio.
So that's a very useful example of an old saying that we used to have, which is the cash is burning a hole in my pocket. You've got it. I've got to put it in. I've got to put it in. Now, my challenge back would be the fundamentals on copper are clearly very strong. Don't disagree with that at all. But why should I buy it now? Is there a catalyst? We talked about this the other day. You've got to have a catalyst, an idea for why. What is the catalyst for this today? Now, one of those catalysts could be what you just said about people looking at corporate action. It's showing you that people are seeing that there's a shortage out there. They need to get exposure. But is there anything else that we can think of as to why this should work for us now?
So as we know, at this time of year, it's when all the analysts come out with their predictions for 2026. And I would imagine that our job here is to guess what they're going to say in 3 to 4 weeks' time. And then when we get fund managers coming back from their holidays in the Bahamas over the new year, what are they going to be buying in those first 2 weeks of January?
Suntan lotion. Sorry.
After sun.
After sun.
And alongside that as well, then I think that copper could be one of the main targets. So I'm just looking to get ahead of that and any run up into the end of the year. Because Santa needs copper just as much as all the data centers in the US do, that the Chinese do, and our friend Elon with his EV production.
I mean, I think there's, as I mentioned, there is a chance that China do some more stimulus as we go into the new year because, like I say, their economy is lagging and they don't want it to slump too much. And the other thing is, of course, Trump may at some point consider that copper is a strategic asset, a metal that he hasn't really got involved in yet. So if the supply side got too tight, you could see him make some moves in that area. And maybe that's some thinking behind BHP going for Anglo again. But those are just, up in the air. I don't know. And clearly no one knows that. Otherwise, the price would be going up a lot more.
So the way I read it is I've received a lot of great advice here, which is actually telling me nothing about why it's going to move in the short term. However, I recognise when I'm on a sticky wicket and that we are only talking about 2.5% of the fund. And, if it puts a smile on Rich's face for Christmas, then it's worth us doing. So I'm going to say we will take 2.5% out of cash and put 2.5%, another 2.5% rather, into the Wisdom Tree Copper ETF.
Which leaves us officially fully invested. Is that right?
It does leave us fully invested, but I'm thinking of the 10% gilt holding as a bit of reserve cash. And therefore, I like to think we have some cash for a rainy day. But I think it would be right to say, given the comments we made last week about the amount of risk we've got in our portfolio, our friend of the show, Peter, will, I'm sure, burnish us with another a rundown of our portfolio now with this extra copper in there and tell us how much risk we're running. I think we're pretty much loaded in risk now. We are ready for the Santa rally. We are watching very carefully to see what happens.
I think, on Peter's point, and we talked about the volatility of copper being the second biggest or most volatile asset in our portfolio behind the Van Eck crypto and blockchain ETF, which we know really does move 10 or 15% a week. Peter rightly pointed out that it is our second biggest volatile asset. Now, if you think about that, it's because they had a lot of that volatility, or the high volatility for the last year has been because of that massive crash we had back in the middle of the year. And if you strip that out, the volatility would be substantially lower. It would still be reasonably high, as most metals are. Most metals have a volatility around 20. And, because of the spike in the year, it sort of went up another 50% above that. So it's important to remember that. That gives me some comfort that we're not just going to buy something that suddenly could fall another 30%. Of course, you can never say never, and you don't know what's around the corner. But that seemed to me to be a one-off impact, which we'd never seen before.
I could tell what's coming.
I am grabbing the yellow card. I very nearly went for red. But there are stories that I've heard throughout my life, and this is one of those examples of people making things up as they go along. So, what always used to happen is people would say, oh, the inflation numbers are up 5%. But if you take out everything that went up, they're only up 2. And isn't that a good number? No, it's 5%. And so the volatility of copper is high because it fell 30%. You can't strip it out. However, that's enough of that rant. We've decided what we're going to do. We're fully loaded for the year end.
Come on, Santa.
Oh dear. You win the 3 awards. The names are in lights.
Yeah.
You go fully invested.
Oh no.
Yeah, it's all over.
The bear has turned bull and we're fully invested. We know what happens next, don't we?
Yep. We know what could happen next, but I'm very confident that our superior fund management skills will show us forward, and we will have a lovely Christmas. I've got my fingers crossed, my toes crossed, and my eyes crossed.
They will be after what you're going to be drinking on Christmas Day.
I thought you were looking at me weirdly.
Get 5% back on your investments. Open a new account and invest a minimum of £50 by the 31st of December and keep at least £50 invested until March. You'll get 5% on your invested value from 21st of November until the 31st of December. Your capital is at risk. New customers only. Offer valid until the 31st of December on ISA, GIA and SIP accounts. Maximum payout £100. Terms and conditions apply.
We thought we'd take the opportunity this week to catch up on some of your great questions that you've been sending into the email address. So we'll go straight on to the first one, and that comes from Philip. I wondered what Rich, Mark and Chris think about stop losses. Are these tools that investors should be using as standard, or are they either unnecessary or dangerous? The discussion on Spice's oil stock last week, I wondered, why was there no stop loss there? So does CJ. Are institutional investors less able or less likely to use stop losses? Any thoughts? Most appreciated.
Thanks, Philip, for the question. It's like so many questions that one asks in portfolio construction. There's no right or wrong answer. It's what suits you. But let me have a crack at it, and then I'm sure the others will want to join in as well. Some people swear by stop losses. Other people hate them. And the people who hate them end up selling the things they love right at the bottom, and they get really annoyed about it. And we've all done that, so let's all put that one straight out there. Let's think, though, what is a stop loss trying to do? The biggest danger to any position is getting emotionally involved with it. Falling in love with a position makes you do silly things and stops you thinking straight. A bit like Rich with his romances. It's all psychology. And how do you keep your brain focused on the prize? Making that money. How do you keep yourself thinking good thoughts rather than negative thoughts? We're all investors. We all need to remember we can be wrong, and we need to be honest when that occurs. And the stop loss is a mechanical trigger, essentially, which says at this point, I'm selling my position because I got my original thesis wrong. And it gives you that emotional cutout. I'll be quite honest with you here. The best traders I know do this brilliantly They have no history of what they did the day before. And the next day, they'll put exactly the same position on if they believe in it still. And they'll have a fresh way of thinking about things, and they'll be off and running again. I can't do that. I wallow in my depression when I get things wrong. And therefore, I need to look at things in a slightly different way. And so what I do is I think of review levels rather than a stop loss. I will have a level where I will review my original decision, but I must do something at that review level. I can buy more if I've suddenly convinced this is the right thing to do. We were talking with Lee about that would make me a hunter.
A hunter.
I think that makes me a hunter rather than a rabbit. But I've got to do something. And the great thing about doing something is it clears your mind. There is no doubt at all. Every time I've ever done something, I don't know, position's gone terribly badly. I've cut half the position. I'm feeling like a right idiot. You suddenly feel a lot better. And you know then whether you should sell the other half as well, or whether actually that was a silly thing to do and you really do love the position completely. So the way I look at it, I have a review level rather than a stop loss. So that's my answer to that bit. So the question about the oil example is a little bit unfair to one degree, and that is that one of the things you should think about when you're taking your positions is the size of the market in which you're dealing. Now, for most people listening to this podcast, putting their money in their own ISAs, investing in themselves, they're never going to be too big for the market. But if you're like poor Mark over there and you bought 5% of this company, you can't just sell it on a whim. You can't just say, I've got to stop loss, it's out, because you'll never get a decent price, and you'll sell a little bit and it will drive the price all the way down still. So you have a real problem there. What that means, and I've been sympathetic to Mark now I'll put the boost in, right? That's why you need to take action before it gets to that stage. And that's why you need to think about, if you've done really well, shall I take some out to reduce the position so if it goes wrong, it doesn't blow me up? And that was the mistake in that particular example. So that's my answer to the question. Review levels is what it's all about.
I'm somewhat similar on the review level in that I very rarely stop loss myself on 100% of a position. What I will do is cut 20% of the position. And it's incredible the amount of times that when I cut that small part, then that is the low. It's almost like I'm being rewarded by the gods of trading for showing that little bit of discipline. So I think, cutting your whole position at one arbitrary level is maybe a little bit too much in my mind, depending on your level of conviction. There are other occasions when it's a position that I, in all honesty, probably shouldn't have had in the first place. Maybe I'm over trading or having too many eggs. As I heard a great piece of advice this week, that one fund manager takes all his eggs, puts them in one basket, but then watches that basket very carefully. So if we're talking about really high convictions, I'm more likely to buy more as the price comes down if the story hasn't changed, or to cut a little bit and just see how that feels, as CJ says, a little bit of a weight off your shoulders.
There are two things I would probably add. There are two ways that I like to do things. One is if something's gone up and I think, okay, I'm making money, I want to run it. And if you remember going back to Lee's things, I'm more of a connoisseur. I like to run my positions, sometimes too long, but I do like to run my positions and keep trying to get that extra profit. And so what I tend to do is, if we get to a point where you've covered your initial investment, I would take that money out and say thank you, and then you run the rest for free effectively. And yes, if you lose all of it, you've lost all of it. But if you lose some, but hopefully you'll make even more on that extra bit. And you can do something called a trailing stop as well. So you can set it at sort of, I don't know, if it's £1 lower than a £10 share price, call it 10%. As that price goes up, if it does come back 10% or £1 at any point as it's been rising, you'll get taken out of the position. Now you can do that with indices. It's much more difficult with stocks because remember, sometimes stock markets are not open 24 hours a day to deal in individual shares. And indices, you can trade in futures and options that sort of you can trade, 24/7 or 24/5. But with shares, you're at the risk of coming in one morning and the market's down 20% and you had a stop loss in and they take you out at completely the wrong price, not necessarily at the stop you wanted. They'll just clear you out because you said you wanted to get out, and you can lose a lot more money that way. So I've not tended to have those stop losses for that reason in individual shares.
That's another great thing that IG have started to offer on their platform about 6 weeks ago, 24-hour trading. So I can now wake up in the morning and I can trade NVIDIA. I've got the opportunity to. I don't have to, but having that opportunity on a great number of stocks now, including all the Mag 7 and a lot of the other US names that I look at, that just allows me a little bit more freedom around what I'm doing to manage the position.
That's a good point. And hopefully that array of available stocks to do that on will grow, because it would change your ability and to manage 24 hours a day.
Right, our next question is from Stevie. I think this is one for you, Spice. So Stevie has been investing in Barclays and he was up 100%. So exactly like you suggested there, he's taken 50% out by selling half his position. That remaining holding has then gone up a further 45%. And he's sold a bit more. Do you think that's the right way to manage his position? Or is there a smarter way to hedge such situations by staying in the trade but covering the downside risk somehow? For example, he sold way too early on Rolls-Royce and is just wondering the best way to manage these positions.
I think it's very difficult because, every position has its own sort of strengths and weaknesses. Stevie, I like to think you're much a connoisseur like me, that you've taken out some of your position when it's gone up that much, and that's great that it's gone up and you've had that opportunity. I personally like to run things, and I like to run a very small number of stocks. I don't like to have a big portfolio because I've always made my mistakes when I've owned sort of extra stocks just for diversification reasons. There are unit trust rules. So when you run a unit trust, anything that is over 5% of the portfolio, if you add them all to anything over 5%, if you add it all together, can't come to more than 40% of the entire portfolio. And you can't own more than 10% in any one position. So that makes you diversify. It's the rules of the unit trust industry. And basically, the minimum number of stocks you can have is 16. Now, I like to think I know 10 stocks pretty well. If I have to buy another 6, even just to stay in the unit trust rules, that's where I've tended to make my mistakes.
Right.
So what I tend to do is I don't mind running those positions I'm most sort of on top of and I believe in most, even though it might have gone up another 50% or another 100%, please, that would be fantastic. But unless I've got a better idea that can knock that one out and come into your top 10, if you like, it's a competition for capital. I'd like to think, okay, if I'm going to get rid of this stock, I want to have something better to replace it with. And if I've got nothing better to replace it with, why would I sell it? That's my own personal way of doing things. It's not necessarily right or wrong, but that's the way I find. I don't like too much diversification because for me, it takes away from what I think are the key strengths in my portfolio.
I take a slightly different approach, and that is that I sort of think about an investment I make and where I think it's going to get to. I personally don't get upset if it gets to my level and then goes up another pound, another £2, another £4, whatever it is, because I didn't spot that in the first place. So I actually think I'm being greedy by thinking, oh well, it could go up further. I'd much rather get to where I think it should get to, sell it, and if it goes up anymore, that's for somebody else. I mean, there was a very famous person, one of the Rothschilds, who is alleged to have said, after having learned of Wellington's victory at Waterloo, he learned it before everybody else. He had messengers telling him, and so he was able to trade and make a lot of money. And so when everybody else started finding out, he started to sell that to them. I think that's called insider trading these days.
Yeah.
But he said, leave some profit for others, and why not? So now, that shouldn't surprise anybody because I'm a raider, and so therefore I believe in put your money to work, make your money, get out. Put your money to work, make your money, get out. And I find if I try and run things, it doesn't necessarily mean it's going to work. and drive up, it could equally give back what it's made, and I end up having made no money at all. And I just prefer to lock the money away, move on. Lock the money away, move on. So me personally, if you can be a connoisseur and you've got great skills like that, fantastic. If that works for you, brilliant. I much prefer to just say, I've got these positions, they work, I'm out. Next one, and out. And that's how I trade.
Now, since you brought my love life into things, it does sound to me Spice is a bit more of the romantic. He might find his forever love. And Spice, are there any positions that you have held for a really long time or intend to hold forever?
You all know my oil stock, but there was one where I did make a lot of money. And it started as a company called Acorn Computers, which was the BBC computers. It ultimately became Arm Holdings. And
which year are we talking about? We're talking about
so this is in the mid-90s, yeah, 98, 99. Just as the tech bubble was going, Acorn Computers owned this big stake in Arm Holdings. And then Arm Holdings floated, and I had the position in Arm because I owned Acorn Computers. And I held this position. I held it all the way through the tech bubble, I bought them for pennies in the pound, and I sold them in April 2000.
Right at the top.
Oh,
beautiful.
But on that day, they had fallen 20% in the one day. I literally walked around the block and went, oh my God, this is a proper crash coming on because of and I thought this is really the end of the tech bubble. And I decided, I walked back in the office and I sold my entire holding 20% down on the day.
Wow.
It was a very good decision with hindsight because then the shares then plummeted all the way down to below a pound.
Top of the market.
But you don't get that very often, but I had held it all the way up. I'd trimmed it occasionally where, wanted to buy things as you do. But without doubt, for me, that was my best position and the best managed position by me. Because I didn't mind selling it 20% down when it had already gone up 20-fold or whatever it had done.
Okay, and on to our final question. This is from Shirley in Inverness. Gents, you managed to hit your target for the portfolio after just 2 months. Does that change the amount of risk you will take going forward? Or do you have a new target in mind? How should this translate into people investing in their ISA? Should they also have a target in mind for the year? CJ?
Oh, all the easy ones for me, I see. This is a really, really tricky question. And once again, there's not an exact answer to it. It's clearly a question which you're glad to have, because if you're ahead so early in the year, you think, wow, this is great. But actually, it's fraught with problems, however you answer this. First of all, you could say, I've made my target. I'm now going on holiday to the Bahamas, another holiday in the Bahamas, given what you were saying earlier.
Yes.
And then come back at the start of the next period and then start again. And that's a way, if someone said they were doing that, I couldn't really fault them because I'd asked them to do X% that year, they did it. So what can I say? However, I also think you can argue quite successfully that, let's say we think that the market's going to go up 10% per year. So on a 2-year period, you expect it to go up 20%. So let's say it went up 20% the first year. It could equally go down. It could equally stay unchanged the second year. The average would still be 10%. But if we were doing what I was just saying, you'd be up 10% in the first year. You wouldn't have made anything in the second year. So suddenly you haven't achieved your target. So you get to that question of how do you engage to try to make some more money really for next year in the year you're in. To me, I think you've just got to carry on doing what you do with the same process. And I mean with the same process. Don't let the fact you made 10% already mean you take more risk or you throw things around in a different way than you would normally. Stick to thinking, I haven't made my money. How would I invest now normally? But there must become a stage where you say, hold on, I've done so well, I've got to take some out. Now, how do I look at that? Right. Now, I'm afraid this is going to get a little bit complicated. And for the end of the podcast, it's probably not great for those poor listeners who've stuck with us this far. But if we said that you think a market's going to make 10% per annum, let's say, and let's say that it's got a volatility of 10%. Remember, we talked about volatility the other day, which is how much it goes up and down around its average return. So you've got 10% per annum with a volatility of 10. Now, if I do my mathematics and I'm going to say, please believe me, trust me on this, I've got to, if you don't, I've got to go through some really complicated calculations and I'm not going to do that. But if I take the 10% per annum with a vol of 10, an outcome any particular year between 0 and 20 is 2/3 likely. It's likely 66% of the time. So what am I saying there? If we've got something with a 10% vol and a 10% average return, any particular year, you might be between 0 and 20, 2/3 of the time. So 1/3 of the time, you're going to be outside those ranges. But 2/3 of the time, you're going to be in those ranges.
Is that one standard deviation?
That is one standard deviation. But now you see you're starting to get complicated again. And we said we weren't going to do that, Richard. Now, please behave yourself. Right. Okay. So now, in that sense, I start to think that if you can do more than 20% in a particular period, you're now, the likelihood of you doing that again or that not borrowing from a future year is quite low. So my personal view is, given we've got a 10% target and vol's around about 10%, I mean, we're making a lot of sweeping assumptions here. If we get over 20, I'm going to start leaning quite heavily towards reducing risk because we've got to be ready then for the next period, maybe being a little tougher. And we want to save some of that performance and be ready for opportunities, but just be a bit cautious that we've had a out of sample, is what you would call it, return this year. And maybe next year, it's going to be a bit tougher. So that's my answer. 10%, I'm happy, but we carry on doing exactly what we've been doing. No flippancy, no egos. Oh, aren't we brilliant? We've won an award. Oh, sorry, that's what we've just done. Sorry.
Literally what we've just done.
None of that. When we get to 20%, though, or around that sort of level, let's reduce out some of the stuff and let's change some of the way we've been doing. So change our process to buckling the hatches down a little bit in case things get a bit more tricky. But until that point, we carry on.
All I've heard there, Spice, is if we get up to 20%, he's taking us on holiday to the Bahamas.
You can hear whatever you like. There's lots of room at the back of a plane.
Jet2 holidays.
He'll turn left and we'll turn right.
I'll send the drinks back.
£50 off right now, Jet2 holidays. That's £150 for a party of 3.
I mean, I believe in making hay while the sun shines. And I've said, unless something comes along to change it, and like I say, bull markets, which is, if we, we are in a bit of a bull market at the moment, that's great. It's not a raging bull market, in my opinion. There are some signs of bubble characteristics, as we've talked about many times in the previous podcasts. But unless something comes along to change that, there needs to be a catalyst for that direction to change. Therefore, personally, I'm happy to keep riding that wave, make the hay while the sun shines. And yes, if something comes out or you think, oh, blimey, that's unusual, or share prices start reacting in different ways to information. So if a share price you expect to go up on something fantastic goes down, you have to ask yourself why. And then that might make you want to take some risk off the table because that might be an early warning sign. But for me, I'll keep doing it. And, if you're running a fund as a professional fund manager, you are paid to keep taking that risk. People pay a management fee for you to continue to take that risk.
Right. So I'm going to put a challenge in there. Right. I'm going to put a challenge in there. Is there not a level where you would say, do you know what? I've got to think that this has got a bit out of hand without seeing a sign of a stock performing badly. And I go back to our little oil example, right? There were no signs there that there were any problems, right? But it had done so well, we know the right decision to make if it goes sufficiently far is to reduce some risk. So my challenge is, I understand what you're saying, that we start to see bad signs somewhere, but if we get a problem with no sign, COVID, for example, suddenly out of the blue, bang, right? Or we take various flash crashes or something like that, right? Is there a level at which if we're up by X% in a particular year, I mean, I've said 20%, is there a level where you, Super Bull, would actually say, do you know what? I've made out so well here. I'm going to take some money off, even though it all looks brilliant and everything's going up.
Not a level. I genuinely believe that you should continually reassess every day, day in, day out. Now, the borders thing, I learned a lot of lessons. And, I put my hands up. I should have seen, when I saw gas condensate rather than oil, I should have just got on the phone and sold it before the broker rang me and made me an insider. History is history. Couldn't do anything about that. But in terms of when you talk about overall markets, I think I don't tend to have a level. Now, there are big equity people tend to have big psychological levels. In share prices, I might be, when something gets to £1, it'll oscillate around £1. When it gets to £10, it'll oscillate around there. £100, it'll oscillate. And you see that lots of times, which is why some companies will have share splits, to make their share price come back from £10, whatever it is, to make seemingly more cheap to buy, but it's not. It's exactly the same valuation. But it's a trick of the trade because equity people think psychologically. So let's say when the FTSE 100 gets to 10,000.
Hallelujah.
Right. Are we going to sell our FTSE 100 position when it gets to 10,000? Nothing has changed. It's up at 3. It'll be 3% higher than here. And it's just got to a big psychological level. We'll be donning our caps and go, yee-hee, yee-ha, we got there. But the chances are it could go up another 5% or down another 5%. But there's nothing fundamentally changed other than it's hit a 10,000 level, which psychologically, now some investors may just say, 10,000, that's my level, I'm out. And good on them. But then I would say if it comes back in, you buy it because it'll oscillate around 10,000 and then it will move higher again after that. That would be the way I'd do it.
So what that highlights, I think, is how tricky it will be to get Mark to sell at the top.
You know me too well.
I do. I've had that issue before. Because Mark will turn quickly once he sees the evidence of a problem. I'm trying to get out while we're ahead of that. Now, I might be wrong. Well, I normally am wrong with this sort of stuff because it has been right to stay longer in the party because it's kept going up. But at some stage, it will be right to say, and we will be trying to persuade Mark over there, and we will have to decide to overrule or not. But that's I'm setting up the conversation for at some stage in the future how we handle it. But it's a great question.
Well, what reassures me is we've already experienced that in the VanEck blockchain and crypto ETF, right? We were up 35%. We sold half. It then went up to 52%. And he wanted to buy more.
Well, I didn't. But we bought it in the dip.
It then went to up 52%, and we didn't sell the rest. We stayed in the party. So I guess we've had an early sign of what could be to come in early 2026.
Yeah, I mean, look, A, this is a great problem to have, right? But B, there's no exact answer here. It's what you feel like. And what I would say works well between the three of us, certainly between Mark and myself, because we work together a lot, but I know the same with you, Rich, is we all respect each other in our views. And therefore, if one of us feels they want to do something, the other two in the end will say, okay, you want to do that, it's your responsibility, but we respect you for, your view and taking that decision. And then we'll all get behind it.
And that's the great thing from the viewer's point of view as well, of course, is that, of course, there will be things that we talk about and we have views on that you will disagree with. And that is the art of investing, isn't it? You can have differing views and everybody's portfolios can look slightly different.
And that, as you say, Rich, is the great thing about this industry that we're in. We can all have different views. We can all have conflicting views. We can all agree. Everything is an individual approach. You've got to do what's right for you. And all we're trying to do is help people with our experience negotiate the financial markets.
Fantastic. What a great note to finish on then. And thank you for those emails. Now, if you want to send us in any more questions, where should they write to, gents?
The Art of Investing at IG.com.
And a special thanks to IG as well for enabling us to bring you this podcast every week. The new award-winning podcast, The Good Money Guide, Best Financial Podcast of 2025. Gentlemen, well done. And listeners, thank you so much for your votes. We'll see you next week.